Hello and welcome back to Simple Money, Canada's own personal finance podcast, presented in short and informative episodes. Today we're going to continue our investing series and explore your investment management options, ranging from do-it-yourself investing to robo-advisors to fully managed investment accounts. So to clarify your options, this decision can really be plotted on a spectrum. On one end, you have the complete self-management of your own investments. And on the other side, your investments are fully managed by a third party, such as a bank or a credit union. Typically, you'll have lower fees and higher responsibilities when you manage your own investments. In comparison, you'll have higher fees and lower responsibilities when your investments are fully managed. This spectrum also has gray areas where you may have a hybrid of investment management strategies. For example, there's been a recent growing number of fully managed advisors that use robo-advisors to take care of their clients' investment portfolios. As a financial coach and educator, I like to empower individuals to manage their own investments and understand the decisions made if they have a managed portfolio. Thankfully, if you do want to take care of your own investments, it's never been easier. There are a large amount of self-directed investment brokerages that allow you to manage your own portfolio. Plus, fees have been gradually decreasing over the past decade due to increased competition. In other words, there are more options available to you, and they're also cheaper. If you are looking to do your own investing, you'll have to open up something called a self-directed account. This is a special account that's offered by a financial institution that allows you to do your own trades. You're able to open up self-directed accounts for RSPs, tax-free savings, RESPs, and more. So to begin, a good place to start is by looking at the self-directed accounts offered by your financial institution. Fees are very similar between most self-directed accounts, and self-management is typically easiest if you do it where you bank. So for example, it's easier to transfer money between your checking account and a trading account if it's at the same financial institution. Self-directed accounts are easy to set up, typically have low annual fees, if any, and also have very competitive commission expenses. Commissions are very important to understand, as you'll be charged every time you buy or sell a security. So it's important to be conscious of this. The downside with self-directed accounts is that lower fees also come with higher responsibilities. You will be 100% responsible if you decide to go with a self-directed account. This means that you'll have to pick the right type of account, design the portfolio, rebalance it, make tax planning choices, decide when to buy and sell, and more. With that being said, there are actually lots of sample portfolios that you can use to make self-directing investing easy. We'll be doing a whole episode on portfolio design and then another on the famous strategy called couch potato investing in just a few weeks. A good beginner strategy is really to slowly invest on your own and then gradually increase your exposure over time when you feel more comfortable with it. So next up on the spectrum are robo-advisors. The basic idea behind robo-advisors is that your portfolio is managed by complex algorithms that make investment choices and subsequently manage your investments. The big benefit for robo-advisors is that the fees are much lower than traditionally managed accounts. So for example, one of the big robo-advisors charges only 0.5% of your total portfolio's value in a year. This is in comparison to bank-issued mutual funds that can charge anywhere from 1 to 3.5% a year in management expenses. We will be exploring mutual funds versus exchange-traded funds, or ETFs, in a future episode. Another big benefit is that robo-advisors will automatically rebalance your portfolio at no extra cost. If you invest on your own, you would be required to pay commissions when you rebalance your portfolio. The downside with robo-advisors is that they can be too simple and not customize their recommendations to your true situation. And in many cases, they will not optimize tax planning. However, with that being said, robo-advisors are increasingly hiring people advisors to offer a personalized touch to their services. The popularity of robo-advisors are growing on a massive scale. Some of the big robo-advising companies in Canada are Wealthsimple, WealthBar, and Nest Wealth. Robo-advisors are typically more hands-on than fully managed financial services because you'll still have to make choices that complement your existing financial plan. Finally, we have fully managed investment portfolios. These are services that are offered by financial institutions that manage your funds and invest to a financial plan that they will usually design. This option comes with the highest price tag, but usually comes with a comprehensive financial plan designed specifically to your situation. Depending on your representative's level of expertise, the investment plan could also include complicated tax planning strategies, estate planning goals, and much more. There are many levels of fully managed portfolios, but the most common one is when you meet a financial advisor at a bank branch. In this case, it's likely that this representative will try to set you up with a mutual fund portfolio to help you achieve a specific financial goal. These mutual funds will typically charge an annual fee of 1% to 3.5% depending on the portfolio design. And in all cases of managed investment portfolios, the true strength comes from the quality of the representatives that are advising you. Optimally, you want a competent advisor that fills your needs and meets with you on a regular basis. And very importantly, every representative that you meet should be fully investigating your needs in detail before they make any recommendations. That's it for today, but it's important to determine which investment management strategy will best complement your lifestyle and to be realistic about the responsibility behind this choice. Thanks again for listening to Simple Money. If you have any questions or would like to make any future episode recommendations, you can send me an email at info@ffcoach.ca, or you can find me on Twitter at _F_coach. Thanks again for listening to Simple Money. If you have any questions, or if you would like to make a future episode recommendation, you can send me an email at info@ffcoach.ca, or you can find me at Twitter at F_F coach. Take care and talk to you next week.